Anthem Blanchard, CEO of New Metra, and you're listening to RunToGold.com.
Hello, this is Trace Mayer, and you're listening to the RunToGold.com podcast. And today I have a special guest with me, Aaron Crown. Hello, Aaron.
Hey, Trace.
Doing great. And you run ml-implode.com, which is Mortgage Lender Implode, and that's the largest website in the sphere, right, in regards to basically anything real estate.
Yeah, it's basically the mortgage lending aspect of it. There's probably some foreclosure websites that are bigger now.
Right, and that's what we're going to be talking about is foreclosures and how the next wave of residential foreclosures seems to be on the horizon. Just like we had this tsunami out in American Samoa, it takes a long time for that wave to travel.
Well, you know, the way I would put it is that it was more like a hurricane, and we had the first side of the hurricane hit, and then we went through a rather large eye, which was time that was bought from spend and pretend that was rained down on the banks. And then we have the other wall of the hurricane that's starting.
We had the mark-to-market accounting changes, and so we've got a lot of these bad loans that aren't being written down as bad loans with the banks. And now we're having the next wave of these coming. Is that kind of what you see in the market?
The figures are starting to show that foreclosures are back to exceeding where they were at the worst of the foreclosure wave last year, which throughout most of the country was basically postponed with moratoria. They extended the foreclosure process in California, which put a big dent in the numbers that were going through on a monthly basis. And that is back to, or actually above where it was before. I don't have the numbers handy, but it has exceeded the previous high. I believe the latest data is another 7% increase or so, month over month. So another record high. So foreclosures have started again. And the question to ask is why? You know, I thought didn't subprime already pass? And it did. It did pass. But the problem is subprime was not the only subprime, which is to say that the loans that were actually called subprime, which didn't even used to be a bad word, became a bad word, but they're not the only garbage loans that are just as risky, just as toxic. There's a whole universe of Alt-A loans, which were people with higher credit scores, but the loans had other properties that made them risky, and there was pay option ARM loans where you could pick a payment that would actually cause your balance to increase, and that's what most people did. And there are even prime loans that they basically had, gold-plated qualities, but the problem is that you had a job yesterday doesn't mean you'll have a job tomorrow, especially in this economy. So delinquencies and defaults are rising even on those. So that is starting to hit now, and hit in a pretty big way. And the modeling I've seen suggests that will continue at a high level, probably increasing somewhat in terms of foreclosures for the next 2 years at least.
Oh, man, this is just really turning into a pretty bad hurricane, because I think I was reading one of the headlines about unemployment and how only 500,000 people lost their jobs, and so the percentage of jobs lost was down. And I was like, well, of course it's down after you've lost how many millions of jobs. Of course, when you lose the same nominal number, the percent's going to be down. And so now we're starting to see this unemployment cut into the real middle class of America. It sounds like the people who are, for the most part, responsible with their finances, they're now finding themselves unable to make their mortgage payments, and they're starting to become delinquent, and filings are starting to happen and things like that. Where do you see this going?
Well, I don't see anything put in place to really stop it or mitigate it, rolled out, trumpeted by the administration, or really they don't remedy the problem, aside from the fact that they have problems getting the banks to actually process all of these distressed cases because it's voluntary on the part of the banks. Even when they do process the cases, all they're basically doing is giving an additional forbearance. So they're basically forgiving fees or tacking them back onto the balance, and maybe lowering the interest rate somewhat for a temporary period of time, but only very rarely are they actually lowering the interest rate permanently, and they're almost never giving principal reduction. It's probably the key thing needed in terms of affordability, because valuations on the properties and the mortgages, therefore, were were pegged way too high. And until that is remedied, people will be stuck in their houses, and they will be won't be able to refinance. The affordability is always on, unless they have ridiculously low interest rates on a permanent basis. Will be stuck in these houses and really not able to afford them. So we're seeing actually in the statistics 50% slightly worse recidivism rate with people going back into delinquency even after this sort of loan workout.
Right, so the banks are kicking them while they're down, and just when they start to get up, the banks hit them again. And
well, they're kicking them, it's kicking the can down the street a little bit is all it is.
And you mentioned interest rates. There's talk that if asset prices begin to rise, the Federal Reserve says that they'll raise interest rates. And one person said, oh, well, that's the asset they must be looking at is gold. If gold were to go to $1,500 or $2,000 an ounce, then that's when the Fed would raise interest rates to defend the dollar. But that's really not going to happen, is it?
They can't. Yeah, they're stuck. They're absolutely trapped. They're trapped on mortgages. They're trapped. They're trapped everywhere. I mean, there's a whole complex. The whole system, the whole financial system depends on low and interest rates that just get lower and lower. I mean, there's so many bonds shorted, they can't raise rates. There's so much on federal life support, as it were, that and there's no where else are the banks earning money? Where else are all these financial companies earning money? There's still a severe recession, still consumer retrenchment and spending. So it's not like private sector's awash with all this money to replace this welfare coming from the Fed and from the government. So they're really trapped, and I just don't see any way out of it. Now, then they've got all the toxic assets.
Yeah, they've got all the toxic assets on the balance sheet of the Fed. They got the FDIC, which is for the funds gone now, and of course they've got that line of credit with the Treasury. So that's why we aren't necessarily going to see bank runs. But all of this weighs on the dollar. And
right.
So it seems like we're getting closer and closer to this currency crisis that seems to be looming over the horizon, which really overshadows all of this, because that's the largest bubble of them all, is the Federal Reserve note dollar. Like you said, they're trapped. Say, well, how's it going to play out? It's not going to end well. Who knows exactly how it'll play out, but
I hear this argument a lot that the saving graces of the dollar is that pretty much the world is filled with garbage fiat currency, and I think to a great extent that's why the system has limped along as far as it has, as long as it has, but that can only save it for so long, before other countries get on with their recovery and sane monetary policy, or more sane, I guess I should say. As time goes on, more and more people see their ability, gold, silver, and other real assets, and will just kind of leak out of the financial system. That creates a feedback effect where it harms the dollar, and makes it harder for the Fed to do what it wants to do, because there's just not a tidal wave of cash waiting on the sidelines to come in and rescue all the banks and these toxic assets.
The zombie banks. And now we're seeing the elections in Japan. They're moving to much different direction with their government in terms of a little bit more limited in scope. We're also seeing that with the recent elections in Germany, and then they have the ATM machines for gold in Germany. And so it seems like the rest of the world is looking for those alternatives, and they realize...
I think the real bullish one is in China, where the government has officially encouraged people to go and buy small gold and silver bars, and they've dramatically extended the availability of them at your local branch bank. There's nothing like it in the United States. There hasn't been probably more than half a century. There couldn't have been, because it was outlawed in 1933, and it wasn't re-legalized till 1976.
Right, and so we've got this Beijing put now on the physical metals to counteract the gold cartel. Alan Greenspan saying that central banks stand ready to lease gold should the price rise. Well, now it seems like people are demanding the physical, and it's putting a lot of stress on that market, and China's just kind of throwing a whole bunch of gasoline onto that fire by getting all of their citizens to buy it.
Accepted view amongst the smart money, the real smart money, is becoming that central banks have been manipulating the precious metals market to suppress the price of gold and silver. You can take two perspectives once you realize that. You can either not fight them, or you can see it as an intensely bullish setup and a buying opportunity.
Right.
And the two of us feel about that.
Not just us, but you've got Greenlight Capital switching everything from their GLD ETF into physical bullion. We were just talking about my article on the ETFs before the show about how there might not be actual physical bullion in them. And now we have this multi-billion-dollar hedge fund shifting their billion-dollar position out of the ETF into the physical bullion. And so, yeah, it does seem that this confidence gain is evaporating.
I'll mention also that John Paulson, who was famous for shorting subprime CDOs early, a lot of people have noted that he's gone into buying some banks. Not as well recognized as that he's heavy into gold. Mining shares, I think he's the biggest shareholder of AngloGold Ashanti now. Big owner of physical gold, I believe. He probably owns a lot of the ETF. I'm not sure. It's not as optimal, of course, but he is a big owner of gold as a base position now. And so when you look at that against the bank shares position, well, to me it's obvious what this is. This is a hedge where the bank shares are call options on the government bailouts. If the government bailouts, to the extent that they're successful, the bank shares will rally, and they have rallied off a very low base. But, the cost of that is likely to be inflation, in which case the gold will be attractive. Or if the bailouts fail ultimately, well, that means the financial sector is under distress. So again, the gold wins. So I would just not buy the financial shares, but I guess he gets some leverage out of that, again, treating them as a call option. So I think it's a very shrewd play, actually. Gold is the core of that play. And this is Paulson, I think, had the highest returns in 2007 and 2008.
Right, and you also don't necessarily know the other types of positions that he's taking on those banks with some of the options to hedge them. Brett. A lot of the smart money, like you said, they're realizing, man, this thing's just not going to end well. What is going to be worth something on the other side of the abyss? And of course, you turn to the precious monetary metals instead of real estate, for example, because real estate can be burned down in a riot, whereas your physical metal.
In real estate, I think this is an important fact. Real estate became financialized to such an extent that a lot of fictitious value was injected, and that distorted the pricing. So you had what was supposed to be the ultimate safe investment, for most regular people, became 30, 50, 100% overvalued, and it's been a complete and utter disaster. So
a lot of that due to the insane leverage that you saw coming out of the investment banks.
Insane leverage. That is the crux of being financialized, is when it's that easy to get that kind of leverage, and you just have way too much liquidity, powered by leverage. Can it be put any more clearly than the fact that we had a TV program called Flip This House? You're going in and buying and selling a stock, the next day. It's ridiculous. So the houses in real estate became, to a large extent, not real. Every time someone tells me, real estate's a real asset, it's like, well, unless the value gets inflated too much, financially, it's not very real. So you have to look at something that is.
I have a friend who's a commercial property appraiser, and we were talking about valuations and how you value real estate. And he said, it's a derivative of the future earnings from the property or the land or whatever it is. And to some extent, that's true. But to another extent, it's not, because assumptions that go into figuring that out from a financial engineering standpoint. And so it just made me
your model.
Chuckle. He gave a couple of different models, like the discounted cash flow or future cash flow model, and I'm just kind of chuckling at it, and man, don't we remember what happened with LTCM? We had some of the brightest minds coming up with models here, and yet the models failed. I think what we're seeing happen, especially with a lot of these mortgage-backed securities and CDOs and other loan pools that are beginning to fail, and ones that ordinarily wouldn't have even had a very high probability, they're now slipping further and further towards that.
to LTCM, just look at what the ratings agencies were doing routinely. The models were bogus. Their job was to rubber stamp them, not to really put them through the pace. So, and banks are being allowed to still do that, to mark the model, and it's a shame, and it's really harming the economy and harming the country.
Leading to a big misallocation of capital is management of perception economics. If we can manage the perception, then everything will be all right. But, at the end of the day, if you're out of shape and overweight, you can have all the positive thinking you want, but you're not going to run a 6-minute mile. I think that we're starting to see a little bit more of reality, illusion that's been kind of pulled over everyone's eyes, and the effects of it have been masked through just this willful denial.
Well, anyone who bought into green shoots, they believe that the share rally has been the confirmation of that. I think they're going to be sorely disappointed again, and as shocked as they were when the market crashed last year, because the housing woes are back. The real estate woes, commercial and residential, are back, and there are trillions in losses that have yet to be taken.
And the P&E ratios?
Yeah, they're insane. They're absolutely insane.
And the dividend payout ratios, dividend to earnings payout ratios, all of it is just right at the normal bound. Truly, there are no markets anymore, just manipulations. And so Paulson's taking this hedge both on the government bailouts working, but also on complete collapse in the sense that he wants the physical metal. It's very interesting to see the world teetering on such a fine razor sharp edge.
Yeah, I really have to wonder, how they're going to try to spin flood of data. It's really starting to come in with the foreclosure stats and the latest, home sales and home price stats they're really starting to deflate after the new first-time home buyer tax credit. That's mostly passed. Pretty much already have had a contract going at this point, and would have had to order your new home months ago if you're going that route. We're running out of the fumes that the market has been running on for the last year.
Okay, well, I think we've had a good interview. Thank you for coming on. And you've been listening to the RunToGold.com podcast with our special guest, Aaron Crown from MLImplode.com.
This is John Rubino from DollarCollapse.com, and you're listening to Run to Gold.